It is Friday the 25th of March, and unbelievably the portfolio hasn't spectacularly violently imploded. And that's because the markets have continued their surge up in the last couple of weeks. And so for the week, we're up 107,000 Swedish crowns, and for the year, we're up this much. So that much at the current exchange rate is around 33,000 euro, or roughly equivalent of 36,000 US dollars. Take a look at the performance of the Standard & Poor 500. You'll see in the last couple of weeks it's run up, which could mean that the conflict in Ukraine has been priced in. We also look at the Nasdaq, and that's managed to salvage its way back to minus 10% for the year. Year to date, we're up 21.3%, and that's despite the move down in the US dollar as compared to the Swedish crown. As I highlighted in my last video, a lot of my positions are in US equities, and so fluctuations in the US dollar Swedish crown currency pair does affect my portfolio. When it comes down to stock selection, there are a couple of approaches to this. There are two ways that are advocated when it comes to stock selection, and the first method is by using qualitative analysis. Put simply, it's just the use of subjective judgment to analyze a company's value or prospects based on non-quantifiable information such as management, expertise, industry cycles, and strength of research. So the other method is by the use of quantitative analysis. So quantitative analysis is a determination of the absolute or relative abundance of one, several, or particular substance present in a sample. Basically, the first method is spending hours upon hours in reading all of this, and then making sure you click all of these links, and then further getting your head done in by reading all these passages. And then you're trying to fight off hypersomnia by having all these extra links to click on, and then trying to wrap your head around these numbers. And so the second method is sort of getting hit by these sort of illustrations with lines and numbers and candlesticks and oscillators, and trying to decipher something intelligible out of things that look like this. In reality, the application of both methods is just a time-consuming, elaborate, grandiose way of establishing confirmation bias. I don't have the time nor the inclination to spend countless hours perusing through 10K filings or trying to distinguish candlestick patterns on a chart. Like most things, you don't need to be precise, you just need to be approximately correct. Investing is just an aggregate of all market participants exercising their individual philosophies. And so therefore there is no one right answer, and there are many ways to win. This is why two opposing actors in the market with two conflicting views can both make money. So long as you have basic foundational understanding of market dynamics, and you buy strong, adaptive organizations and then hold for a long time horizon, then anything else is just excess. The simplicity in investing is often overshadowed by complex financial jargon.
I love that it's still sitting like that.
So you don't need to be well versed in all the financial literature to do well in the market. I'm a long-term buy and hold dividend investor, and I try and make as little decisions as possible, meaning I'm not in and out of markets. But this just means that I avoid trading or jumping in and out of markets or following the latest trend or meme stock. Further, I'm also a contrarian investor. And all that means is just I do the opposite of whatever is the current market sentiment at the time. So I think armed with some basic principles, anyone can do well in the markets.